Please do this question on your own before you look at my explanation. It says bank depositors in the United States are all financially protected. So these guys are financially protected against bank failure. Okay, so even if the bank fails, they are financially protected because the government insures all individuals' bank deposits. So the government is insuring. So let's say you deposit 5 lakhs in a bank account and the bank fails. Now the government gives you those 5 lakhs. Okay, and that also happens in India, by the way. I think there is an upper limit, probably 5 lakhs is the upper limit to which the government insures. An economist argues that this insurance is partly responsible for the high rate of bank failure. So this insurance, the this guy is arguing that this insurance is partly responsible for the high rate of bank failure. So a lot of banks are failing because of this insurance. Why? Because it removes from depositors any financial incentive. So now the depositors do not have a financial incentive to figure out whether the bank that holds their money is secure against failure, right? So now you don't care whether the bank is secure against failure or not. You know that you put your money there, and now even if the bank fails, you're going to get your money from the government, right? So you don't really have a financial incentive to figure whether the bank is secure against failure or not. And the economist is saying, okay, that's why the insurance is responsible, because now you don't have any incentive. Okay, so I don't have any incentives. So how is that leading to high rate of bank failures? Okay, the next statement explains, if depositors were more selective, banks banks would need to be secure in order to compete for depositors' money. Okay, so if depositors were more selective, so if I really cared about the bank in which I put my money in, then banks would need to be secure, right? So if people are taking calls depending upon which bank is more secure, then banks would need to be secure in order to get people's money, right? In that case, that would lead to a lower rate of bank failures, because then banks are actually striving to be secure. Right now, they are not striving to be secure because people don't care whether the bank is secure against failure or not. And the reason people don't care is because they are insured by the government. So essentially, insurance is leading to people don't care, and that's leading to banks not caring to be secure, right? And that's leading to high rate of failures, high rate of bank failures, right? So you can see this whole chain starts from insurance, and that's what the economist is saying. This insurance is partly responsible. Okay, it's saying partly responsible. It's not saying this is the only factor that's leading to high rate of bank failures, but it's saying it's playing a role there. Okay. Now the question is, it makes which of the following assumptions? So we need to figure out the assumption. Option A: bank failures are caused when big borrowers default on loan repayments. Okay, so when these big borrowers default on loan repayments, they don't really pay back their loans. In India, it happens a lot. So, so bank failures are caused then. Okay, that's fine. This is the bank failures happen when this happens, but the whole point remains the same, that the banks could be more secure, right? They can be more careful while selecting big borrowers, and the reason they are not really caring about to be more secure is that depositors don't care, and the reason depositors don't care is the insurance. So just knowing that bank failures are caused when big borrowers default or small borrowers default or whatever has no impact, because the whole argument remains the same, right? They can be more secure while figuring out which big borrowers to give loan to. Option B: a significant proportion of depositors maintain accounts at several different banks. Okay, so significant proportion of depositors are maintaining accounts at several different banks. So they are not maintaining accounts at just one bank, they are maintaining at several different banks. So, so what? So are they selective? Are they not selective? Right? It could be that even though they are maintaining at several different banks, they are still not very selective. Just that whichever banks call them up, sir, please deposit some money in our account. They say, yeah, why not? I don't care. Right? So just because they have maintaining accounts at several different banks doesn't really tell me about whether they are selective or not selective. They could be selective in choosing those several different banks. For example, I keep my accounts in five different banks, but I am selective which five different banks. Or I may not be selective. Um, so it has no impact. The more a depositor has to deposit, so the bigger amount a depositor has to deposit, the more careful he or she tends to be in selecting a bank. So the bigger the amount, the more careful. So it's actually think people are actually careful if they have to deposit a bigger amount. The argument is actually in the opposite direction. The people don't care. People don't have a financial incentive. And now it's saying people actually care if they have a bigger amount. So it's going against the argument, right? It's actually going in a weakening direction that actually it's not really removing any financial incentive. People are still caring about it. So it's weakening. Option D, the difference in the interest rates paid to depositors by different banks is not a significant factor. So again, it's a negative statement, so I'll negate it right away. So the difference is a significant factor in bank failures. Okay, so this could be a significant factor in bank failure. That's fine. We are just saying this is insurance is partly responsible, right? So there could be other factors, significant factors also that are responsible for bank failures. Insurance could still be a factor, right? So the negation is not really breaking down the argument. Rather, does it have any impact? The difference is a significant factor. It has no impact because okay, this is a significant factor, but our whole argument still holds as is, right? That this whole thing still holds. That people don't care, so banks don't care to be secure, and the reason people don't care is they have insurance. Okay. Option E. Potential depositors are able to determine which banks are secure against failure. So, if they are able to determine which banks are secure against failure, if you think about it, if they are able to determine and they are more selective, then it supports this point, right? If they were more selective and they are able to determine also, then the banks would need to be more secure, right? Think about it. If they are not able to determine which banks are secure, then even if they were more selective, uh, why would the banks would need to be secure? Because they just can't determine, right? If they are not able to determine, so what would their selectiveness do, right? If they're not able to determine, then this whole point that if they were more selective, then the banks would need to be secure in order to compete for depositors' money would just completely break down, right? Because then banks would not need to be secure in order to compete because these guys just can't figure out, right? So the negation is going to break down the argument and directly it's a strengthener and the negation breaks down. So it's a valid assumption. Option E is the answer.